Hello, everybody. Good evening. For the second session, we'll continue on non-resident taxation. Uh, we're going to get into the sources of income and other parts today. What I would do is we'll just do a quick recap in terms of whatever we covered the last session. And what I would want is I want you all to participate in the recap as well, which is in the form of a MCQ. So this way we will just quickly refresh our memory, and then that will also help us set the tone to continue with the other major sources of income that we normally encounter in a non-resident taxation, which is into royalty, FTS, which we are going to deal today. So what I want to do is, I will put the questions. These are basically whatever we discussed the last class. And I would want you to give it, of course, A, B, C, D is not there. So whatever is the right answer, you can type in the portal dashboard. So I'll have a look at it. So this is, again, as I mentioned to you, recap and also setting tone for today's session. So the last we did look at the very fundamental aspect of taxation system, which is residential and source-based. And we all know for residents, it is taxed global. When it comes to non-resident, there are certain scopes of income with which a non-resident is taxable. And what are those scopes of income is what is part of our agenda for today and the next class as well. Primarily dealing with taxing the non-residents. So one of the aspects despite getting into the income, one aspect we wanted to touch is when can a foreign company be a tax resident in India? Because an Indian company under Section 2(26) of the Act defined, which is registered in India, becomes an Indian company. But there are situations when Indian company automatically becomes a tax resident. So there are situations in which a foreign company would also become a tax resident. When will that be? So you can give in your answer as to whether its place of control should be in India, the control and management should be held in India, or if its place of effective management is in India, or if its place of accounting records is in India. So you can quickly, by now you would have typed the answer. I request all to participate as well. If in case you missed the session as well, it will help you. So that way, whatever you've missed, we'll try to encapsulate through this recap. So I'll move on to the next one. To determine a poem in India for a foreign company, a major determining factor is, so once a foreign company, so you have the answer for the first one here. If there is a place of effective management in India for a foreign company, how do you determine that? What are the yardsticks? What are the hallmarks in which one would say that, the foreign company? So these are the determining factors. Would you look at the passive business should be outside India? Active business should be inside India? Or active business should be outside India? Or passive business should be inside India? So which of these options will be the major determining factor, pursuant to which you will keep looking at other factors as well? But this is a major factor which the CBDT has given a guideline in terms of taxpayers can assess whether there is a place of effective management in India. So you can please key in your answer. Which of these will be a major determining factor? Now, I'm not discussing the answer because the next question invariably will have the answer for the previous question. Now, moving on to the next recap one. Companies shall be engaged to active business outside India. So which means the answer to the previous question is obviously it has to be active business outside India. It's a factor. And once you don't satisfy, based on which you will go to subsequent criteria. A company shall be engaged to active business outside India if what are the tests that is given to see the active business outside India test? Is it the foreign company passive income is less than 50% of its total income? B, its the foreign company should have less than 50% of its total assets in India. The foreign company should have less than 50% of its total employees in India, and its payroll expenses on Indian employees are less than 50% of its total payroll expenditure, or is it all of the above? So which one would be the test in order to classify the ABOI? So all these will determine as to whether a company satisfies. If you satisfy the ABOI test, then life is pretty easy, which means then you have to look where the board decisions are taken. If they're outside India, then automatically it is presumed that the foreign company is a non-resident. If you fail to meet the active business, that is, you have a passive income more than 50%, or your assets in India are more than 50%, then there are other various factors you'll also have to look into as to where does the decision taken, where is the headquarters located, where are the accounting records kept, various guiding factors that is given. Moving on, one another aspect that we touched upon to determine passive income, because as we all know, traditionally passive incomes are your accreted incomes. Active incomes are your business income, your normal active income. Passive incomes are which you put in and made from a main income that accretes, like your rent, royalty, dividend. But the POEM guidelines has one very interesting passive income addition. Which of these? Is it income transactions where only purchase of goods from or to its AE? Income transactions where only sale of goods is from or to its AE? Income transaction where both purchase and sale of goods is from or to its associated enterprise? Or D, none of the above. So as you can see, this is very unique. So go ahead, give your answer, but please watch out the nuance involved in it. So it should ideally be where both purchase and sale of goods should be from AE. These are exam questions. Normally an examiner will try to test these aspects so you can outsmart the examiner if you are mindful about these particular small nuances. Now moving further, after we spend considerable time on identifying when a foreign company, how relevant it is in the modern day, as I mentioned yesterday, very relevant, because nowadays we are having a lot of outbound investments. India is no more an inbound. India also equally does a lot of outbound. So what I mean by that is, today India-based companies go set up abroad, spread their wings. Unlike the olden days or a decade back, where we are still dependent on foreign investments. But today there are a lot of Indian companies like Oyo, Ola, they're all going abroad and trying to spread the wings, the Reliance Group or the Tatas. So we can see a lot of outbound activities happening, Indian companies going to Africa, setting up manufacturing, etc., etc. So therefore, it is very important, because if these companies are set abroad but the decisions are taken from India, if it is effectively managed from India, then it opens up Pandora's box, whereby these foreign companies can become tax resident. So that's why it's practically very relevant and very significant aspect. One aspect on the POEM before we move on to this is the threshold is very important. It is 50 crores. So up to 50 crores, even if it is effectively managed in India, should not be an issue. Now, moving on from POEM, the other aspects, then we moved on to the next important, which is the sources of income. Now, when can a non-resident, what is the scope of a non-resident's income? And we look particularly at deemed to accrue or arise in India, because that specifically says and any income that is deemed to accrue or arise in India will be taxable for a non-resident, because for a non-resident, only Indian income is taxable, which can be accrue or arise, which is deemed to receive or received in India, or deemed to accrue or arise in India. And one of the first aspects we looked at is to have a business connection in India. So I want you to just go back, refresh your memory as to of this in this particular question, in which of the following situation will a business connection trigger for a non-resident while conducting activity through an agent in India? Is it if an agent in India has an habitual maintenance of stock for the non-resident, habitual maintenance of stock for regular delivery for the non-resident, occasional maintenance of stock for regular delivery, habitual maintenance of stock for occasional delivery. So basically, I was trying to play with the words here, but the larger picture I'm looking at is there has to be an habitual maintenance of stock for a regular delivery. So if that is the case, then the agent, which means the underlying principle of doing business in India vis-a-vis to doing business with India. So if you have this habitual maintenance of stock for regular delivery, then you are trying to do business in India. So habitual is very important, regular is very important, which shows there is consistency for the non-resident to keep doing business in India. Continuing with the deemed to accrue, a Netherlands employee working for an Indian company gets his salary credited in his Dutch bank account. So the FEMA provisions, the foreign exchange provisions, allows Indian companies to pay salary 100% outside India. So this is very well within the foreign exchange guidelines. So Netherlands employee working for an Indian company can get a salary credited in his Dutch bank account. It is not important that the money should be deposited only in his Indian bank account. I can very well deposit in his home bank account, which is Dutch bank account. So the employee contends that this is not taxable in India as the salary is received outside India. So he says the salary is received outside India, therefore not taxable. So deemed to accrue arise in India. Now this is where it says as long as if the salary is for services rendered in India or it is for salary earned in India, then it becomes deemed to accrue arise in India, irrespective of where the salary is received. So the answer to this is false. It is taxable, employee is taxable, even if the salary is received outside India. Moving on, again, very straightforward, simple. What about dividend received? But today we have a lot of foreign investors investing in Indian companies, listed, unlisted. Any dividend paid by an Indian company, not taxable because it is accrued outside India. False. These are deemed to accrue or arising in India. Section 9, Clause 1, Subclause 4. The last aspect before we move on to today's is, again, this is the fundamental. For a non-resident, the scope of taxation under Section 5 in India is income received, income accruing, income deemed to accrue or arise in India, all of the above. We have discussed this quite a number of times. It is all of the above. And a very important factor is India deems certain income that accrue or arise in India, thereby gives a legal fiction to it. So even if the non-resident contends that the contractual is very clear that the source is outside India, income tax goes one step further. They say, no, I'm not bothered about the contract, I'm bothered about the statute. So they made a legislation deeming fiction to say that these incomes are accruing or arising in India. Therefore, non-resident will be liable to pay taxes in this. So with this, we will move on to today's session. Just let me see. I don't see much of participation, but really appreciate if and I would request participants to please do send in your answers. It will help to understand. Let's keep it very interactive. Okay, let me move on. So we finished off with deemed to dividend, and then now today we are going to look at three very important aspects on interest, royalty, and fees for technical services. The other major three incomes, which is very essential, and these are very common income that a non-resident earns in India. So one need to be extremely well versed, or this is something which we also practically come across. So this more often than not, this is what these incomes will be more tested from an exam standpoint as well. Interest, royalties, and FTS. Now, there are three classifications that for all these three income, interest, royalty, FTS, who pays it matters. If it is paid by the government, there can be three possible payments. The Indian government making a payment to a non-resident. These are incomes for non-resident, so you can understand. So government making payment to a non-resident, resident of India making payment to a non-resident, and a non-resident making payment to a non-resident. I'll tell you what is the significance. So this is very important for you. So when does an income deemed to accrue or arise in India? When there is a payment to a non-resident or the income of the non-resident pertains to interest, royalty, and fees for technical services. Now, if the government is making these payments, it is automatically deemed to accrue or arise in India. This is not only for royalty, it is also for interest and FTS. It's common factors. So if the government is making these payments, then any payment made by the Indian government to a non-resident for interest, royalty, FTS, then it is deemed to accrue in India. If a resident Indian, that is an Indian company or an Indian partnership firm or an individual, he or she makes a payment to a non-resident on interest, royalty, FTS, these are deemed to accrue or arise in India. But there is one exception. We will also look at few examples on the exception as well. The exceptions are if it is payable in respect of business or profession carried on outside India or for the purpose of earning income from any source outside India. So, so they are saying, because in the income tax legislation says, the Act says, if the resident is making payment to a non-resident on royalty, FTS interest, but if these payments are for a business that is being carried on outside India by the resident or for the purpose of earning income from any source outside India, if it is for any source outside India, then it will not deem to occur as in India. In all other situations, that is, if it is the converse, if it is carried on in India or for the purpose of earning any income from a source in India, then it will be taxable. So a resident is making payment to a non-resident, it is automatically is deemed to occur as in India, except that is why I given excluded, except when if it is for a business or profession carried on outside India by the resident or for the purpose of earning any income from any source outside India by the resident. So if it is for business outside India or for earning income from any source outside India, then in such scenario, it will not be deemed to accrue or arise in India. What about non-resident making payment to a non-resident? Will it deem to accrue as India? It sounds weird to you, right? Why should a non-resident make a payment to non-resident? Why should it get deemed to accrue or arise in India? Just keep this concept. We will dwell deep in terms of some examples to make it clear. It is taxable, but only in one scenario. That's why I mentioned it as inclusion. Only in one scenario, a non-resident making a payment, royalty, interest, FTS to another non-resident will deem to accrue or arise in India if it is payable in respect of a business carried in India or for the purpose of earning any income from any source in India. So for a resident, if it is outside India, excluded. For a non-resident, if it is for a professional business carried in India or earning any income from any source in India, then it is taxable. So for government, no exception. Any Indian government automatically makes payment, it gets deemed to accrue or arise in India. If a resident makes a payment to a non-resident, it is deemed to accrue or arise in India, except if it is for a business outside India or for earning any source of income outside India. If it is a non-resident making payment to another non-resident, then it is deemed to accrue or arise in India only if it pertains to a business or profession carried in India or for earning income from any source in India. So just keep this broadly in mind. We will look at some examples which you will appreciate this. This is common for all the three: interest, royalty, FTS. Of course, there are all three different types of income, but this is a fundamental factor for deeming to accrue those incomes in India for the non-resident. Now, having looked at the common factor, let's delineate this further, and then let's go into the nature of these incomes. The first one is interest. Now, what is an interest? Interest is already defined under 2 clause 28A of the income tax, which is an exhaustive definition. It says interest means interest payable in any manner in respect of any monies borrowed or debt incurred, including a deposit, claim, or other similar right of obligation, and includes any service fee or other charge in respect of the monies borrowed or debt incurred, or in respect of any credit facility. I don't need to dwell deep on this because you would have already seen this. And anyway, under 194A also you need to, there are TDS implications and other aspects. Anyways, so if there's any interest payable that is done under the 228A definition, 915 will trigger. Now you need to also keep in mind that we are not looking at treaty today, but that is very important. We are only looking at the domestic law implications, because as I mentioned the other session, what is very important is first look at the domestic law implications. After you have a clarity in terms of domestic, then you can go to the tax treaties to see if there is any benefit available under tax treaty. Now, I'm just giving you a small example of how treaty has defined interest. The reason for treaty defined, in fact, as a matter of fact, India's royalty and FTS definitions are inspired from the tax treaties. So tax treaties were the first to define what a interest, what a royalty, what an FTS is. Of course, interest was already there in India law, but royalty FTS is a inspiration, or if you see, it is very similarly worded to tax treaty. In fact, we transposed it, or we took it from the treaty and put it in the act. So treaty had played a major role. Now, under the treaty, if you look at the interest definition, this is just very important also. The interest is very widely defined than the domestic law. For example, the term interest, I'm taken from UN Model Convention, as used in this article means Article 10 of the Model Convention, means income. Article 11 means income from debt claims of every kind, whether or not secured by mortgage, and whether or not carrying a right to participate in debtor profits, and in particular, income from government securities and income from bonds or debentures, including premiums and prices attaching to such securities, bonds, or debentures. It also clarifies that penalty charges for late payment shall not be regarded as interest for the purposes of this article. Now, you may wonder, why should a treaty define? The reason for a treaty defining interest, royalty, or FTS is to maintain consistency, because they don't want these interest, royalty, FTS to also be, defined in if it is defined in domestic law. You cannot expect the same way how India is defined, UK will also define, Nigeria will also define, Bhutan will also define, Sri Lanka will also define. So to have some sort of a consistency, they started to define in treaty specifically. So that way, countries also, when they put it in their domestic laws, they will take inspiration from the treaties, which is actually what happened in India, because India's royalty and FTS definitions are largely inspired from tax treaties. The idea is to have some consistency. But as you may, the reason for me mentioning this distinguishing is the treaty is surprisingly very expansively worded. So when you make a payment to a non-resident and you have to see whether that characterizes interest, you should look first the income tax definition, and then you should also have a look at treaty definition as well. But for our discussion today, we will be focusing only on the domestic law definition. So with this, I think we will take one problem for better understanding. So I'm in problem number 10. This has been uploaded. These problem exercises, you can download it. So we are in problem number 10 here. Now, if you go to question number 10, ABC Limited had a contract with XYZ Inc., which is a US company, for purchase of goods. As per the contract, on failure to make payment within 30 days of the shipment of goods, XYZ US will levy a penalty, that is, the seller will levy a penal interest of 1% of the invoice value per month until the payment is made. In this regard, XYZ US wishes to ascertain whether the penal interest charges will be liable for taxation in India as interest. So the contract between an Indian company and a US company is the Indian company will purchase goods. That is, it will import goods from US. The US seller says, you need to make the payment in 30 days. If you don't make the payment within 30 days, I will levy a penal interest of 1% of the invoice value per month until the payment is made. So therefore, in this regard, XYZ wishes to understand. Now, this is a classic situation which you normally come across practically, because now me going back to the treaty again, if you recollect, specifically the treaty gives you a benefit. Penalty charges for late payment shall not be regarded as interest for the purposes of this article. Now, this is treaty. Fine, very good. Treaty clearly satisfies. So if there is treaty benefit available, I will get an advantage. What about domestic law? Domestic law says interest payable in any manner in respect of any monies borrowed or debt incurred, and includes any service fee or other charge in respect of the monies borrowed. There is no specific exclusion that penal interest for late payment should be excluded. We have few tribunal different judgments, but going purely by literal interpretation, it appears that penal interest will come under 228, because there is a debt incurred and there is an interest being payable for a debt incurred by virtue of how a debt is incurred. Through operational debt has been incurred, and therefore 1% should be leviable as an interest. So therefore, under section 9, clause 1, subclause 5, since this interest is paid by a resident and this is for a business in India, therefore this will not come under the exception clause. This is deemed to accrue or arise in India for the non-resident. So under section 220, by virtue of section 228A, this will be taxable. Now, having seen interest, I'm not going to go into the more nuances. So this is what you need to keep in mind. A resident making a payment to an interest to a non-resident. And does it come under interest definition? Yes, comes under interest definition. Is it, will the exclusion clause will come in? No, exclusion clause won't come in, because it is payable in respect of business profession carried on inside India. That is for inside India. Therefore, the other exclusion will also not come, and hence it is taxable for question number 10, the problem. Now we will move on to royalty and fees for technical services. Now, Section 9, Clause 1, Subclause 6, royalty and FTS was introduced in 1976. Again, thanks after India started to enter into a few treaties. So this is a largely treaty inspiration. Now, why do you need, what was the need for, in India was very smart to have royalty and FTS in its tax treaties, because we will see why there's a need for royalty FTS. India was a capital importing country. So at that point in time, what we needed was technical know-how. India did not have the capability to do innovation. We wanted these foreign companies to set up factory. So we wanted them to come to India and help us give services to India. Today, it's a different ball game. Today, we see Indians are also coming out with a lot of innovations, patent, and we giving to outside India also and providing services, especially IT services. But in those days, we are largely dependent on the developed economies for development. So what happened was, all these developed economies said, when they came and gave this capital know-how, the know-how, transfer of intellectual property, giving licenses, they say these are not taxable because there is no source in India. All these sources are only in my home country, because I am providing these services. The contract is entered in the foreign country. So going by the contract, and enforcement of contract is also in the foreign country, in the home country. Therefore, it should not be taxable. So to counter this, India introduced 916 and 917 by making them deemed to accrue or rise in India. And they say there has to be a tax payable in India. How much? I'll come to that. But this is a very, very significant move, especially for developing countries. So thereby you are trying to eliminate saying that this is not a source in India by virtue of 916 and 917. 917 is fees for technical services. India is deeming these incomes as accrued or arise in India. Now, what is also very interesting to look under the definition of Section 916, if you can have a look at it, it's a very, very widely defined definition under the Income Tax Act. Royalty is extremely wide. If you can see in front of your screen, royalty means, which is again a very exhaustive definition, not an inclusive definition. Royalty means consideration, that is even for lump sum consideration, for transfer of all or any rights in respect of a patent, invention, secret formula or process. So any rights in respect of a patent, invention, secret formula or process given by a non-resident, for which he gets a royalty payment, will be deemed to accrue or rise in India. Use of any or imparting information. So it's not only about transfer, even use of a patent, invention, formula or process. So formula or process, as you can understand, it can be for medical, Coca-Cola's processes. So therefore, these formula process, mere using of that will also amount to being and payment for using that will amount to royalty. And transfer of all or any rights in respect of any copyright, literary, artistic. We are going to see, for example, usage of software. Transfer of all our rights in respect of films, videotapes, telecast or radio broadcasting. Use or right to use an equipment. So a foreign equipment is being leased to India and I use it, machinery, then I may make a payment to it, they are royalty payments. Imparting of information of industrial, commercial, scientific knowledge, experience or skill. So as you can see, explanation 2 to section 916 defines what a royalty is. And again, very widely worded. So one should be extremely vigilant to look at these definitions. You can see the definition so wide, I can put it in 4 buckets, with respect to intellectual. with respect to intellectual property, where you do a trade, that is, you get a license, patent, and do a trade. Possess and control the intellectual property. Obtaining knowledge, technical know is very important, and right to use the product of the intellectual property, like equipments. So broadly 4, but very, very widely defined in terms of what could be royalty. Now, explanation 2 to section 916 defines royalty. So as I explained, please keep this in mind. If a government is making payment to a non-resident, it automatically deemed to accrue arise in India. If a resident is making payment of royalty to a non-resident, it is deemed to accrue arise in India. However, if the resident is making payment to a non-resident, the royalty for a business or profession that is carried on outside India or for earning income in outside India, then that is excluded. A non-resident making payment to another non-resident, royalty for a business or profession carried in India or for earning income from any source in India, then in such a scenario, for the non-resident, there will be income deemed to accrue arise in India will come. So this common factor you need to keep in mind, especially the exceptions. Now, before I go further, as you have seen already, explanation 2 to section 916, the royalty definition is so wide and so exhaustive. We saw all transfer of patent, etc., innovation. We did look about transferring rights, know-how. Let's look at some of the possible issues or practically how do we encounter some of the situations. Now let's look at question number 11. XYZ India, an accounting firm, subscribes for a software called IFS from IASB USA. IASB Inc., which is a USA software company. The software consists of financial statements of all the US listed entities at one place. Now, XYZ India, which is a resident, pays a yearly fee of USD 5,000 for the license, whether such income is liable to tax as royalty. So now XYZ India gets a license subscription, just like how you and me pay for Amazon India Prime subscription or Netflix. Similar to it, but here it's a completely different software. So by getting licensed to it, they can go use the software through cloud or whatever it is. They will they'll look at the financial statement of all US listed companies. Now, whether this income is royalty. The first thing you have to look at it is, before we go, we need to first understand whether this is who makes the payment. The payment is being made. The payment is being made by a resident, XYZ India, which is an accounting firm. And it is for the purpose of business. The accounting firm wants these US listed entity financial, probably for consolidation, because an Indian accounting firm cannot do audit outside. So it's very logical that an account is only for the purpose of business or profession carried in India. So the exclusion won't apply here. And they're making a payment to a non-resident. So in all likelihood, this is deemed to accrue or arise in India. But before concluding, we need to see whether this will come as a royalty. Now, as you have seen, royalty means transfer of all or any rights, including granting of a license in respect of a patent, invention, transfer of all or any rights in respect of any copyright, literary, artistic, or scientific work, use or right to use equipment, imparting. So now, the question here is, the software company gives a license to me to view the software and get the financials. The question is it a copyright or a copyrighted? Now, how does it make a difference? There is a difference. I go buy a book of Chetan Bhagat. That is copyrighted. I go buy soap. that is copyrighted. I go to Amazon Music or Spotify Music and listen to a song, that is copyrighted. Meaning I just use it. But if I buy, say, Chetan Bhagat's book and I'm going to make a movie out of it, then that is copyright. I only buy these soap or a paste. I don't get the rights to keep making similar paste and sell it in India. So the software which I'm getting is only like a copyrighted product. I can only view it. Like your Microsoft Office and Excel, I go buy this Excel and Office. They give me a license. I only work. I cannot replicate or make duplicate Microsoft Excel or sell Microsoft Excel and Microsoft Office products in India. Again, your Computax or your Winman, whatever tax software you're using in your office, they give access to it. No, you cannot do a copy. So this copyright versus copywriter is a Copyright Act or an intellectual property law related issue. This was being globally, so this is a global issue. So this issue came up in India, and the courts have consistently held that merely obtaining a license to view something is a copyrighted and not copyright. Only if there is a copyright, royalty will come in. So now what the government of India was not very happy with it, because government of India says, no, this will be, in anything will be, as long as they get a license to use something, it should naturally be a copyright. So therefore, it has to come under Section 916. However, courts have held that no, this is copyrighted. There is no question of royalty. So what India did is to clarify this. So we had a lot of judgments going against India. So India made an amendment, introduced an amendment in 2012, explanation 4, to nullify all these judgments. The consideration for use or right to use of computer software is royalty, by clarifying that transfer of all or any rights property includes and always included transfer of all or any right or use or right to use, any right of use or right to use a computer software, including granting of license, irrespective of the medium through which such right is transferred. So what essentially they are trying to say is, for removal of doubts, that's how the explanation 4 will also come. For removal of doubts, it has been clarified that the transfer of all or any rights has always included transfer of all or any right to use a computer, even right to use a computer software, including granting of license, irrespective of the medium through which such right is transferred. So essentially what they have done is they have made it very wide to ensure that even right to use a computer software will also amount to royalty. So coming back to this specific question, by virtue of explanation 4, so now by virtue of explanation 4 to section 916, this becomes a royalty, because even a right to use a computer software, whether you give license or not, they have also said including grant. So explanation 4, you have a look at it, which we saw in study material. Therefore, this becomes a royalty. Now, why is this very, very significant? This is very significant because The domestic law has been amended. You remember I mentioned the session saying that the royalty and FTS definition in India is inspired from the tax treaty. Now, the tax treaty does not have an explanation for equivalent. Explanation 4 was introduced under the Domestic Act, right to use computer software. But if you look at tax treaty, the tax treaty contains the wordings like what you saw in the slide. Royalty means transfer of all any rights, patent, use of any information in respect of any copyright. It only says in respect of any copyright. So there is no mention about computer software. There is no mention about right or right to use a computer software, unlike explanation 4. So therefore, courts have held that recently, last year, Supreme Court, in a very landmark judgment, has held that your treaty does not have such a wide definition. So therefore, treaty definition will prevail, because under the Income Tax Act, Section 90, which you will see, we will discuss more into Section 90 in the next couple of class when I do double tax relief. Section 90 gives a benefit that an income tax payer can choose act or treaty, whichever is beneficial to him. Repeat, act or treaty, whichever is beneficial to the taxpayer. So for the taxpayer, he says, look, the treaty definition does not have explanation for, because treaty has to be amended. When they entered into a treaty, they did not include this. I told you explanation 4 is after a lot of litigation, because taxpayers contended that mere use of software. For example, I also buy a database software. I just do database, want to see what are the number of companies in India, market survey. The contention of the taxpayers is they are only mere use of a database. What they mean by copyright is you should be in a position to further use it, exploit it. It's not about listening. Merely because I listen to a music, that doesn't mean that I buy a copyright. I'm only buying a copyrighted product. But if I take the music, let's say it's a Tamil music, and then I use the tune to make it a Hindi music, then what I make payment to the music composer is a royalty. Merely me buying a music through iTunes or Wink does not mean that they are royalties. So courts have also agreed to it. Treaty does not have the amendment, but the Income Tax Act has now specifically included this. So therefore, purely from a domestic law standpoint, by virtue of explanation 4, answer to question number 11 will be taxable, because explanation 4 has now made it very, very exhaustive. Now, moving on to question number 12. ABC USA pays royalty to XYZ Germany. Now, please observe the question. ABC USA, which is a US entity, pays royalty to XYZ Germany, which is also a non-resident entity, for providing technical know-how to cater to Indian market. For providing technical know-how in order to cater to the Indian market. The technical know-how shared by XYZ Germany will enable ABC USA to manufacture goods and export to India. So they pay royalty. USA pays royalty to Germany. Why? Germany provides technical know-how to cater to Indian market. Based on this technical information input, ABC USA manufacture goods and exports to India. Whether such income is liable to tax as royalty under Section 9. Now, there is no doubt that this is a royalty, because use of or imparting information of patent, innovation, secret formula, technical know-how, all these things are all covered very exhaustively under Section 916, royalty definition coming under explanation 2. Now, what is very interesting to see is this is a non-resident to non-resident payable. So now this is where you go back to this common factor and see whether this is deeming to accrue arise in India for Germany. Now, XY is the ABC, the USA entity, ABC USA makes payment to the German entity. Now, what you need to know is the royalty is payable by whom? Royalty is payable by a resident. So this will apply. Now we need to find out whether it's deemed to occur in India. It can be deemed to occur in India if it is the royalty is paid in respect of business or profession carried in India, or the word used is or, for the purpose of earning income from any source in India. So therefore, one can say that the payment made by USA to Germany is for the purpose of earning income from a source in India, from any source in India. So therefore, this will be deemed to accrue arise in India. There is a royalty, and this is deemed to accrue arise in India for Germany. So clear? So just because there is a payment happening between two non-resident, you cannot say that the income won't accrue or arise in India. Income will still accrue or arise in India. Because if it is for earning any income or source in India, then it will become a taxable aspect. And this is a clear royalty payment because technical know-how is being shared, intellectual property is being shared. Now, having said that, we will move on to, so the main reason for me showcasing this question number 12 is the non-resident inclusion. So please watch out. You cannot merely come to a conclusion because the payment, the transaction is happening between two non-residents. This is very much within the territorial because there is a nexus. What is the nexus? The nexus they are saying is for the purpose of earning income through or any source in India. Now moving on to question number 13, which is again a very interesting fact pattern that put in, especially keeping in line with the modern and a very interesting issue, which I have also encountered practically. Zomato Private Limited. So I go to question, just have a look at question number 13. Please look at question number 13. So question number 13 says, Zomato Private Limited decided to avail Starlink. For many of you who, I don't know if you have heard about Starlink. Starlink is Elon Musk's internet pet project. So under the Starlink, what will happen is, okay, I'll come to Starlink, but just let's finish the question. So avail Starlink internet broadband services from Starlink Netherlands. Under this, Starlink will provides a user terminal that can be kept at Zomato. Zomato Private Limited is an Indian company. So provides a user terminal that can be kept at Zomato's office premises in India. The broadband charges to be paid to Starlink Netherlands will be a yearly amount of 1,000 euros have to pay yearly for the subscription. Starlink Netherlands uses a satellite transponder in the lower Earth orbit, which is outer space. Determine whether this will amount to royalty charges. So an Indian company avails Starlink's broadband services. Starlink is based out of Starlink Netherlands. So the contract is between the Indian company and a Dutch entity. A yearly subscription, yearly broadband services, internet, 1,000 euros. Starlink Netherlands uses a satellite transponder. Now, why is this very relevant? This is relevant even past. Now it's become all the more thanks to technology. Now, what will happen in a Starlink broadband? How it happens? Even you, me, and I can subscribe to Starlink. Now, basically, what the LEO Earth orbit I mentioned, Starlink sends its satellite through rocket. Through rocket sends it, and from Starlink Netherlands, they will send it or wherever it is. So the Starlink's satellite will be in LEO orbit, low Earth orbit, which is in outer space. And Starlink Netherlands will have a ground station. And this is Zomato or you and me, which will be our house or office in India. Now, what Starlink will do is once we subscribe to this broadband, this is a user terminal. So you will get a small satellite round type, very small. You can keep it in your terrace, balcony, wherever you want to. So a signal will go to the satellite, uplinking will happen here, and downlinking will happen to your house. So there will be an uplink and there will be a downlink. Now, this is what is happening even for you take your Tata Sky or any TV channel. What you do is, instead of this coming directly to you, those TV satellite companies will have a downlinking this thing, and then they will in turn give it to us. But now what Starlink is trying to do is eliminate, and they are directly. So you will have a straight access. So uplinking from the ground station in Netherlands, the transponder, satellite transponder. Transponder is basically receiving and communicating, remitting signals. So they'll go there, and then through your user terminal in your terrace or balcony, it will come to your house or your office. Now, question is, when I make a payment, will this amount to royalty? Now, this is not a new age model. This was there 15, 20, 25 years. And as I mentioned to you, this was largely utilized by the television companies. All your TV company, TV channels, they cannot afford to have a satellite transponder. So they will have some satellite companies who will help them in getting the uplinking, downlinking. So, and they will only have a user terminal. And they will engage a company which will have a satellite in the LEO Earth orbit or the satellite transponder. So anyway, the point here is, now the Indian company makes a subscription payment for this broadband. Will this amount to royalty is the question. Now, a resident is making payment to a non-resident. Utilized for a business or profession in India? Yes. Now, what had happened is, why should it be a royalty? Question is whether this satellite, can I say this transponder, is it an equipment? Is it a right to use an equipment? The courts have said, no. Because Section 9 says if you even use an equipment, leasing of equipment also royalty. They said, no. The intention of the Indian party is not for this. This is a service that is being provided. They don't want transponders. They don't want satellites. They only want service. So they said, no, it is not an equipment. Court said it is not an equipment. Now, another challenge which the government was trying to do was, okay, fine, it's not an equipment, but look here. The government's contention is, okay, fine, no problem, I agree, this is, you treat it as a service, but this is a process, and this is the exact wordings that is there under the Income Tax Act. What is a royalty? It is use of any information and for secret formula or process. Secret formula or process. Let me see if I can take this in study material. So this is exactly from the Act. The use of any patent, invention, model, secret formula or process. Secret formula or process. So I use any patent. It can be use of an invention. It can be use of a model. It can be use of a design, comma, secret formula or process or trademark or similar property. So the government said there is a process. What is that process? The process is uplinking and downlinking is a process. This is a process. So for this entire process, royalty needs to be paid because Starlink is giving this process. So therefore, royalty will come. Now, very, very interesting. Now, the reason for me taking up this case also is I want you to understand as tax professionals how to interpret. Now, this is exactly from the Act, the one before your screen. Question is, secret formula or process. So there is no comma here. Oxford comma is missing. So would you read it as secret formula, secret process, secret trademark or similar property? Or secret formula is one and process is separate. Comma trade is separate. So use of a patent, comma invention, comma model, comma design. Secret formula, after that there is no comma. Secret formula or process. So the taxpayer contended the royalty will come only if there is a use of a secret process. Secret is very essential. I give a process which is secret and I give it to a person to use it for which he pays royalty. For example, Coca-Cola's formulation is secret. Coca-Cola or Coca-Cola making certain thing, a process. So there's a taste that comes from, say, Subway. There's a process in their subs, or McDonald's, some burger. It's a secret process. And if I transfer it to somebody in India, they use it. Then they are saying it's royalty. So the taxpayer's contention is it is secret formula, secret process. Department's contention is no. Secret formula ends here. It is only a process. Doesn't matter it is whether secret or not. Now, interestingly, Delhi High Court, in the case of New Skies satellite, has held it that you have to read this as one and the same. That is, it should be secret formula or secret process because there is no comma here. So it is one. Secret formula or secret process is one, and secret is an essential factor. The taxpayer contests that I'm not giving any I'm not revealing that the service recipient, in the case, for example, in our case, Zomato doesn't know how the uplinking happened, how the downlinking, what is the frequency, what is the volume, in which part of Leo Earth orbit the satellite is. He has no idea, no clue. So I am not giving him any secret process. This is not a royalty. The Delhi High Court agreed this is not a royalty because you have to read it as secret process. Now, this case is before the Supreme Court, but what the Indian government meanwhile did is they made an amendment. What is the amendment they made? Bring an explanation 6 to section 916. The term process includes, please read it, and shall be deemed to have always included transmission by satellite, including uplinking, amplification, conversion for downlinking of any signal, cable, optic fiber, or by any other similar technology, whether or not such process is secret. Exactly to nullify the judgments. Because many of the judgments went in favor of the taxpayer and said, only if it is a secret process, only in such situation, it will become a royalty. So to nullify those judgments, now they are very clearly spelled out whether or not such process doesn't matter. Secret is immaterial. So therefore, coming back to this question, this will amount to a royalty by virtue of explanation 6 to section 916. As it is a right to use of a process. So the Starlink giving me the broadband facility by the user terminal which I buy, the satellite will be in my terrace or balcony, and uplinking down, they are saying this is nothing but a use of a process. So therefore covered by virtue of explanation 6 to section 916 as it is right to use a process. Now again, what is very interesting that is happening is, going back like computer software, the tax treaties have not amended to include explanation 6. So you can still take tax treaty benefit. The tax treaty benefit is still available because the treaty has not amended to include explanation 6. This is very similar to what we saw in computer software. The act has been amended to include explanation 4. Explanation 4 was included, and here explanation 6 was included. Therefore, under the act, it is taxable. Treaty benefit is still eligible because treated. So this is what I wanted to convey. The idea of point number 13 is royalty is very widely worded, and as a student of law, especially tax laws or any law we interpret, we should give close attention to the wordings and how the comma help the taxpayer to interpret it as a secret process, which the tax department or the Indian tax authority overruled it by virtue of an amendment by including explanation 6. So therefore, this is royalty as the payment is made by a resident Indian to a non-resident for a business or profession or for earning income source in India. So therefore, this is deemed to occur in India for Starlink Netherlands. This is a royalty payment. If there's any doubt, please feel free to post the same. On to your, before we move to the fees for technical services, let's solve this question in your material, study material, question number 8. Atlant, Italy, a company incorporated in France, was engaged in Atlant, Italy, a company incorporated in France, was engaged in manufacture, trade, and supply equipment and services for a cellular radio. It supplied hardware and software. This is very important to watch. Supplies hardware and software to various entities in India. Software licensed by assessee embodied the process which is required to control and manage the specific set of activities involved in the business use of its customers, and also made available to its customers who used to carry out the business activity. The assessing officer contended that the consideration for supply of software embedded in hardware is royalty under section 916. Examine the correctness. So basically what it says is, the cellular radio tower, there's a hardware which was purchased by an Indian company, and that hardware had certain software embedded in it. So this is a hardware which has a software embedded in it. And therefore, the question is, will this amount to a royalty payment? Because the GSM cellular towers or whichever you get equipments also has software. So the question is, will it amount to royalty? Now, the royalty includes transfer of all or any right to use a computer software. We have already seen this. Now, what is very interesting to look at here is the Delhi High Court, in the case of Alcatel-Lucent, held that the software supply is integral to the hardware, and what the Indian taxpayer wants is, what the Indian taxpayer wanted is mainly the hardware, and software is embedded with it. So therefore, the Delhi High Court held that this cannot be a royalty, because again, the idea was only to buy the hardware, and software is an integral part of it. The idea is not to get the software. Now, why I specifically wanted to take this was, yes, this is a High Court judgment, has a very significant value. Today, fast forward, 10 years back, because 2015, the judgment, so it should have been a case pertaining to 2000 to 2010. Now, today, look at smart devices. We want the software, and hardware is only a peripheral. I put a watch, but I'm more concerned about the software in it. I buy a phone, I'm more concerned about the app in it. I want to know the heartbeat, I want to know various aspects. These are called the IoT devices. So the device is pretty cheap, exported from China, but the software, that's why Apple says designed in California, but all made in China. But why are we buying for it, despite being made in China? Because we're not concerned about the make of the hardware, we're only concerned about the software in it. So therefore, this rationale in the modern day scenario, we have to look at what is integral. Is the software integral or is the hardware integral? If the software is main and hardware is only a facilitator, then section 9, clause 1, subclause 6 will attract. Otherwise, going by the Delhi High Court, if it's only the hardware that I'm concerned about, I'm not concerned about the software, then I can say this is not a royalty. So this is another very technical nuance of looking at royalty. So therefore, just to sum up on what we discussed on royalty, it's a very wide definition as we had looked into it. It contains all the intellectual property related, and thanks to a few judgments in terms of satellite, in terms of processors, in terms of computer software, the Income Tax Act has a very, very wide definition of royalty. It contains trade with respect to intellectual property, possession control, obtaining knowledge, and also right to use equipment. In fact, I still remember one of the cases where I was involved. Madras High Court held that a bareboat ship or a charter ship is an equipment. I get it for a bare lease or a dry lease. I'm not getting into it. But if I just equip a ship alone and I use my crew, that ship is treated as an equipment and royalty will come into it because I'm right to use the equipment. So such is a widely worded definition of royalty. What you need to, however, watch is when there is a non-resident to non-resident payment, see if it is included. If it is for any business or profession carried in India and for the purpose of earning any income from source in India, then it becomes a royalty payment. With this, I will move on to the other important classification income, which is fees for technical services. So by now you would have seen that these are all sources in India. So this become deemed to occur in India, and India gets a lot of revenue because we normally avail these services from non-residents, buying it, be it a software buying, be it getting technical know-how, IP rights. So therefore, these are from an India perspective very important because for a non-resident, all these incomes are deemed to accrue or arise in India. Now, having seen royalty, another very significant is the fees for technical services. Because as I mentioned to you, as a capital importing country, we needed, and developed countries started to give a lot of professional services and technical services work. They had engineers, top class lawyers, economists. So as a developing country, a few years back, India used to avail these services. Today, it's a different ballgame. India provides a lot of tech services to various outbound nations. But normally, it is the developed economy which gives. So therefore, what India did is, if India is availing these services, there should be some tax that these foreign companies should pay. So that's why fees for technical services was made to deem to accrue in India. Any resident making payment to a non-resident for a purpose of business or profession in India, then it should be a fees for technical services. Now, what is a fees for technical services? Again, the term, as you say, it's very wide, very broadly worded with generic terms. For example, if you see explanation 2 to section 9, clause 1, subclause 7, FTS means, fees for technical services means any consideration for the rendering of any managerial, technical, or consultancy services. So it can be any managerial services, it can be a technical services, or it can be a consulting services. So any non-resident providing managerial services, providing technical services, providing consulting services, then it will become deemed to accrue in India. It excludes, however, there's an exclusion in the FTS scope, that any consideration that you pay for construction, assembly, mining, or like project or consideration will not be chargeable or any consideration under the head salaries. So if you're making fees for technical services, payment towards construction, assembling, mining, or project, and also if anything comes under salaries, they are excluded. You may wonder why this construction, assembling, mining projects are excluded. The logic is very simple. Because if you have to do a construction, assembling, mining, or like project, then you have to be in India. So when you're physically present in India, there is a possibility that a business connection will exist because you're doing business in India. But when it comes to managerial, technical, or consultancy services, the presence in India may not be relevant. Having said that, anyway, what I've done in these slides is what could be a technical, what is management consulting. These are all general dictionary definitions I've given because there is no specific definition under the Income Tax Act as to what is a technical, what is a managerial, what is a consultancy. So anything can come, but it's very wide ambit. Now let's take this example This is again a real life situation which I had encountered. So it'll be a good example. A German architect company was engaged by an Indian contractor to design shape for a theme park in India. The German architect firm is based out of Berlin and it provides the design over the email. An Indian company approaches, an Indian contractor approaches a German architect company and says, hey, I have a project to construct a theme park. Can you help me in designing a shape of it? You guys are prominent in it. The German architect firm in Berlin provides the design over email. The design obviously will be used by the Indian contractor for the theme park construction. The Indian contractor makes a payment of 50,000 euros to the German architect company. The question is whether the said payment is liable to tax as fees for technical services. Now, on a plain reading, it is, yes, there is a, you can say a technical services being provided because technical is a very wide word. There's no definition. But what is very interesting aspect is you automatically on the first blush, you will feel that, yes, it is deemed to occur as in India because this is being, payment of FTS is being made by a resident for the purposes of business or profession in India to a non-resident, and hence FTS should come. Now, very interestingly, until 2007, it was very clear that FTS will come because this is exactly the kind of transactions that the income tax India wants to tax in India. Because you look, the German architect company never steps into India. Because for these kind of technical managerial consulting services, you don't need to be present in India. I can just, and today technological epoch, I can just send it over email, or I can even those days they used to ship, courier the CDs, send the documents through shipments. There was no need for them to be present in India because this is not an assembly mining construction project where you need to be in India. This, less like on COVID, I can sit from anywhere in India and take the classes, irrespective of where you are. Or anywhere in the world, I can sit and take these classes. So a German company sitting in Berlin designs and then sends it through email. So this is what the Indian government envisaged in section 917 and says, these are deemed to occur as in India. German company cannot say that, wait, I didn't come to India and everything was rendered from Germany. That is rendered outside India. So it is not accruing or arising in India. To avoid such arguments, the government says these are deemed to accrue or arise in India. Any payment, as long as the payment is made for a business or profession in India to a non-resident, then it should be FTS. So this is very clear because this is the objective. But very interestingly, in 2007, the Supreme Court of India, in the very landmark case of Ishika Wajima Harima. Now, what they said is, wait. If you want to tax it as a fees for technical services for a non-resident, twin conditions have to be satisfied. That is, the services should not only be utilized in India, services should also be rendered in India. So only if twin conditions are satisfied, that is a non-resident who's providing services, those services should not only be utilized in India, should also be rendered in India. This was a very landmark judgment because obviously all taxpayers were happy, especially non-resident taxpayers were happy because there is no need for them to pay taxes. This is also beneficial for Indians also. You may ask how it is beneficial. We are going to see later part called grossing up of taxes. Normally what happens, all these companies, especially the developed economies, they had the higher bargaining power. They said, look, I will provide you the design. I have the capital IQ, I have the knowledge. I want 50,000 euros. If there are any taxes in India, you have to bear it. That is, the payer has to bear it. The contracts will be in such a manner that I want 50,000 net of taxes. If there are any tax in India, as a payer, you bear it. So for the Indian contractor, normally if it is a grossed up or in the contract, if it says the taxes have to be borne by the service recipient, for him, you have to do a grossing up. 50,000 euros, depending on the rate, let's say it's 10%, 50,000 into 110%, it will roughly work out to say 55,000 euros. So the cost goes up. So from an Indian standpoint, also it's a higher outflow. So Indians were also happy. When I mean Indians, the resident payers who were availing these services were also happy because Ishika Wajima said twin conditions have to be satisfied, both rendered and utilized. Now, as always, the government was not very happy. They said, going to that particular point. So the government, what effectively they did is they nullified the Supreme Court judgment by bringing explanation 2. As you can see in front of your screen, income by way of fees for technical services, interest or royalty from services utilized in India would be deemed to accrue and arise in India in the case of a non-resident and be included in his total income, whether or not such services were rendered in India. So effectively, they said rendering in India is not required. As long as they are utilized in India, that is enough. So now, as of now, this will be taxable. So coming back to this particular question, the German company here is liable to tax because in 2012 an amendment was made whereby it was very clearly mentioned that not concerned about rendering, as long as it is utilized in India, 917 will trigger. So therefore, when it comes to fees for technical services in India, the residential status does not matter. The situs or rendition of services does not matter. Whether it's personal or non-personal does not matter. Currency of receipt does not matter. Where the contracts are concluded does not matter. All these things are irrelevant. All it matters is whether are they utilized in India. If that is the case, the non-resident will have to pay taxes because it is deemed to accrue or arise in India. You can also look at illustration 3, which further emphasize on this point. Ms. Vivita paid a sum of rupees 5,000 USD to Ms. Kulashekara, a management consultant practicing in Colombo, specializing in project financing. The payment was made in Colombo. Mr. Kulashekara is a non-resident. The consultancy is related to a project in India with a possible Sri Lanka collaboration. Is this payment chargeable to tax in India in the hands of Kulashekara? So Indian resident, Ms. Vivita is assumed to be an Indian resident. She is paying a sum of 5,000 USD to a non-resident Sri Lankan. The payment was made in Colombo and the project is related to India. So therefore, for section 917, a payment made by a resident to a non-resident for the purpose of business or profession in India and the consulting project. Fees for technical services include technical, managerial, consultancy. So this is consultancy. And this is utilized in India. It doesn't matter whether the payment is made in Colombo or Kulashekara is sitting in Colombo or not. All it matters is whether it is utilized in India, which is the case. So therefore, section 9 will trigger. In the instance case, since the services were utilized in India, the payment received by Mr. Kulashekara is chargeable to tax in India as it is deemed to accrue or arise in India. So again, the common factor, if it is a resident who is making the payment to a non-resident, it deems to accrue or arise in India if it is used for a business or profession in India. However, if it is used for a business or profession carried on outside India or for earning income from any source in India, there's an exception. A non-resident making a payment to a non-resident, it is deemed to accrue in India, provided if that fees is towards a business or profession carried in India or for earning income from any source in India. We will see a few examples as well. Now let's look at question number 14. Messrs. Lehman Brothers USA provides advice to Messrs. IIFL India for raising finance and obtaining loans. The services included study of various lending alternatives for local and foreign borrowings, export credit agencies, negotiation and identify appropriate financier in foreign country. Appropriate foreign financier. The question is whether the income as fees from IIFL will amount to fees for technical services. So basically, a US company provides advice to an Indian entity for how to raise finance and loans, financial structuring. You can look at they do a study of all the foreign borrowers, payment mechanisms, syndicates, etc., and that helps in raising the ADR, GDR, whatever it can be. So whether the income as fees from IIFL will amount to FTS? Yes, because this is because a resident is making payment to a non-resident for the purposes of business in India. Exception to section 917 won't apply, and this is a FTS because consulting services is being provided. Services include, you can either call it a consulting or it can also be a technical, however you want, but nevertheless, this will definitely come under the FTS ambit. And IIFL is an Indian company. This is for the business in India. So therefore, they're making payment to a non-resident, and hence 917 will have track. So this is a Supreme Court case in GVK Industries. One of the first landmark judgments that said, yes, the source of income, they gave a legal sanctity also to section 9, clause 1, subclause 7. Supreme Court case in GVK Industries, where it held that, yes, this will definitely be a source in India, deemed to accrue or arise in India. Now let's move to question number 15. Messrs. Super Florist, an online flower bouquet company, wherein users can order bouquet and deliver it to anybody in India. In order to promote its services, it makes a payment of USD 10,000 to Facebook for online advertisement charges. Under this, the Facebook algorithm will pick up the right Facebook users to display the ad, whether it is fees for technical services. This also has an impact on equalization levy, but just keep it in back of your mind. We will plain vanilla see if this is FTS. Now, a payment being made by an Indian company, Super Florist, an online, maybe I'll make it clear, an Indian flower bouquet company. Now, this is payment made to Facebook. And how the algorithm is, it's work automated. It picks up based on users who are searching for birthday, anniversary wishes, etc., and then displays this ad. And immediately the user can click and says, okay, let me send a bouquet to XYZ. Now, why this is relevant is Supreme Court in SkyCell has held that for FTS, a main factor is there should be a human element. This is very, very important. There should be a human element. Mere automation of services will not amount to FTS. Because what is the purpose of FTS? Technical manager, any professional services, independent, they are actually called as personal services. There is a human connection to it. If there is no human connection to it, and everything happens in a seamless manner, automatic, and there is no human element involved, Supreme Court way back in SkyCell held that there has to be human element, only then FTS. There's no human element, there's no FTS. You cannot say there is a fees for technical services. This was also vindicated in another Supreme Court judgment, this time in the context of Section 194J, which also has fees for professional services and fees for technical services. If you look here, Messrs. K Securities Limited pays to the Madras Stock Exchange a sum of INR 2 lakhs as service fee, wherein the Madras Stock Exchange will provide automated access to the exchange platform for K Securities to undertake the trading activities. Question is whether the payment to K Securities will be treated as fees for technical services. I have given as a footnote the extract from the judgment. You can have a look at it. The Supreme Court in Kotak Securities will say, all securities fully automated are available to all members of the stock exchange. There is nothing special, exclusive or customized service that is rendered to the stock exchange. So this will also, Supreme Court in Kotak also says, this is not a FTS as there is no human element involved. So you need to keep this in mind. But what is very also, of course, from an examination standpoint, this is very clear. But from a professional standpoint, since you're all going to be advisors, aspirants, chartered accountants, the Supreme Court in Kotak Securities also makes a statement that one should also be cognizant of the way the technological developments are happening. Today, many of these services are getting standardized. For example, classic is the case of your tax computation. For many of you in your articles or during the tax filing season, you would have seen your software takes care. All you need to do is key in those relevant places and then the software computes. But ideally, that wasn't the case few years back, where we need to do manual computation, look at the provision, try to fill up the ITR forms, another aspect, which is not the case. And today, technology is also helping. The department is also trying all sorts of things to make life easier. So it will be very interesting to see how this law evolves. But as of now, the human element becomes very relevant. Quickly, I will just finish off these 4 case studies and then we'll go for a break, which will finish off FTS. All in line with what we've already discussed, so you can appreciate it better. See, for example, take question number 17. Kanjipuram Saree Company engaged Miss KK, a UK professional, for conducting market survey in the UK to find out the market feasibility of silk sarees in the European market. Question is, will it amount to FTS? Answer will be, in my view, no, as these are basically services for as a commission agent to identify there is no FTS. But you can always argue, no, market survey, there is a consulting element, but we do have Madras High Court judgment, Evolve Clothing, where they have said market survey will not amount to FTS. Now you can also go one step further. Will this come under exceptions to section? Let's assume it is FTS for a moment. Let's go and see whether they'll come under exceptions. If you go to exception, it is a resident payment to a non-resident. If it is payable in respect of services utilized in business or profession carried on outside India, or for the purpose of earning income from any source outside India. Now you can say my idea is to export these to UK, and it is for earning any income from any source outside India. So therefore, you can also say that these are services utilized for the purpose of earning an income from a source outside India. So exception to section 917 will also help. Question number 20 also talks about exception. If you look here, this is a Madras High Court judgment as well. Exception to section 917. Now here, what had happened is an Indian company had engaged a law firm in Mexico to advise on a proposed acquisition of a Mexican company. In this regard, whether payment of fees to the Mexican law firm for due diligence, advisors, etc., will amount to FTS. The Madras High Court says this payment is made for the purpose of earning a source from outside India, because they are going to buy a Mexican company for earning or capturing the Mexican market. So therefore, this is for a source outside India. So hence, exception also becomes very important. Now, having said that, let's look at question number 19. Mr. D in China, look at the facts. Mr. D in China was paid technical service fee by Bharat Limited, an Indian company. So Indian company making FTS payment to a non-resident. The services were rendered by Mr. D for the branch office of Bharat Limited in North Korea. A branch of a Indian company will also nothing but an extension of the head office, but for Indian purposes, it will be a tax resident only. So can I say, will this come under exception is the question. Bharat Limited is making payment to a Chinese professional for rendering technical service. Now, whereas the Chinese professional rendered technical service, the technical services were provided by him for the branch office of Bharat Limited in North Korea. So let's just go and see whether this will come under exception, where it is payable in respect of services utilized in business or profession carried on outside India, or for the purpose of earning income from any source outside India. Yes, possible. So therefore, this is also no FTS exception under 917. So I leave question 18 for you. So just to quickly sum up the FTS part, technical services, managerial consulting are very widely worded, and there is no need for the services to be rendered in India. As long as the services are utilized in India, will become taxable. Please also look out for the exception clause, because when there are some FTS payment being made to non-resident, it could also be for the purpose of earning a source outside India, or for a business or profession that is carried on outside India. So these are the broad aspects that you need to keep in mind. So we have covered 915, 916, 917, the major sources of income that a non-resident normally has in India, which is FTS, royalty, dividend, and interest. So we'll take a 10-minute break. And then when we come back, okay, fine. Now that we have seen the taxability, what next? How is that it going to be taxed? And how it is important for a resident payer? Because in India, withholding taxes play a major role. So we'll look into that part of the. Now we have seen when a non-resident is taxable in India, in what sources we have seen income due. Now how, what the mechanics, we're going to the last pieces in the puzzle. So we'll take a 10-minute break and then we'll resume. Meanwhile, if you have any questions, please feel free to post them. So let's reassemble at 8 o'clock. Thank you. Now, hello, everybody. Hope you have settled down. So what we are primarily looking at before the break was the royalty FTS, as you may see in front of the screen. We are looking at non-residence income primarily. So when could a royalty or FTS will amount? And we saw the wide definitions. Before I move further, I thought we will just have a look at this particular question in the material, which will just further re-emphasize and probably strengthen the understanding on the FTS. Question 4, JJ Limited, a company incorporated in Australia, has entered into an agreement with KK Limited, an Indian company, for rendering technical services to the Indian company, that is KK, the latter, for setting up a fertilizer plant in Australia. As per the agreement, JJ Limited, the Australian company, rendered both offshore services and onshore. So offshore is obviously outside India and onshore is in India at a fee of 1 crore and 1.5 crores respectively. JJ Limited is of the view that the offshore services of 1 crore, that was rendered outside India, is not liable to tax. Discuss the correctness of view of JJ Limited. So we have seen this. A resident company, KK, is making a payment to the Australian company. The exception is only if it is for a business or profession outside India. That is not the case here because KK Limited has utilized the services for a business or profession in India. The contention of the Australian company is that the 1 crore was rendered from outside in India and therefore should not be taxable in India. So section 917 under FTS, explanation to section 92 clarifies that the royalty interest FTS will deem to occur as in India irrespective of where it is rendered. What matters is if are they utilized in India, services were utilized in India, it doesn't matter if they were rendered in India. So therefore, the entire 2.5 crores will be taxable in India as FTS. And hence the view of JJ Limited that it is not liable to tax is incorrect. It is not correct. Now there's a question which I saw from Namita was, the services relating to Starlink. Why isn't this just a service? Why should it be a royalty? Why should it be a use of process? Now, yes, this is in this modern day is nothing but a services. But what the government felt is they wanted to tax Starlink Netherlands here is they felt, look, you just are not doing a services. Now, please understand, the Supreme Court has clearly laid out that if there is no human element in a service, there cannot be any taxation. So there is no human element, uplinking, downlinking, everything is automized. So the government there is no question of FTS being coming. But government wanted to tax these entities because they felt that Indians are using it. So therefore they thought, okay, why not royalty? Why not call this as a process? Either we'll say this use of an equipment. The Supreme Court, the Delhi High Court and various courts said, no. Satellites are not equipments, they're only a service. So the only point they had was, okay, why not treat this as a process? Because they're sharing a process, why not royalty? Which eventually also has been struck down. So nevertheless, what they have done is they have clarified saying, where there is no human element and where there are satellite transmission and all those things happening, they wanted to classify it as royalty. And that's why explanation 6 was also amended to say process may not be a secret. But yes, on a superficial level, it is nothing but services. So that is why I say going forward, it is going to be very interesting as to differentiating between a royalty and service. I'll tell you why it is very challenging. Today, if you look, there is this fashion to use the word software as a service. SaaS, you buy QuickBooks Cloud, monthly subscription, whatever, your cloud drive, they're all called as a software as a service. This is very interesting terminology the tech companies started to use. But they say software as a service, but then they will collect license payment. They will not call it as a service charge. So whether this is a royalty, whether this is an FTS, this is not an FTS because normally in a software as a service, there is no human element. Will it be a royalty? Yes, because they are transferring a copyright or like a use of a computer software that is there in explanation 4 to section 9. So therefore, in those payments, 194J, we may have to withhold taxes even while making payments to softwares like Tally or any other cloud-based software. So yes, technological development one aspect, but since these are very widely worded, it gets easily captured, be it right. And now you also have something called equalization levy, which we'll see subsequently. That is also has completely given a new dimension on taxing the modern technology companies. So having looked at royalty, having looked at FTS, when can it be taxed, what are the exceptions deemed to occur in India, the next logical question would be, okay, after classifying, what happens to these non-resident companies? Because they are deemed to occur in India, it is a royalty, it is an FTS. What should be done? Now, what should be done is, if it is a royalty, FTS interest, I'll come to 44 DA little later. We'll park it because 44 DA will attract specific tax mechanism which comes as part of a presumptive tax mechanism where you have a permanent establishment or a business connection. So for a moment, we'll park 44 DA. Majority of the cases, you will not have a P, it'll only be a plain vanilla royalty or a fees for technical services or an interest payment to a non-resident. So non-resident will be liable to tax in India with these incomes. Now, how should you tax them? Because they will not be having their books. They're all foreign companies. But you are bringing a deeming fiction under Section 9, and you are saying they have a source in India, and therefore it has to be taxed. Now, how to go about? The government comes out with two mechanisms. One, they're giving a concessional rate of tax. They are saying you don't need to pay 30% or 30% is for Indian businesses, 30, 22, 25 for business income, or 40%, which is the taxable for foreign company. You don't need to pay that much. I will give you a concessional rate of tax, but you pay on the gross basis. So on every payment basis, there will be taxable. You will not make on a net basis because normally Indian company will pay their final tax on a net basis. That is after claiming deductions, expenses, Chapter 6A, etc. Final net taxable income, taxes will be paid on a net basis. However, it will be very difficult to recover. It will be difficult to levy also on net basis for foreign companies because they have global businesses. We are only concerned about India related. So the government says under Section 115A, Chapter 12 of the income tax, which goes as determination of tax in certain special cases. So this comes as a special chapter, standalone. So I will specify certain situations. If you come in those situations, your tax rate will be there and it has to be on a gross basis. They have put a separate computing mechanism, just like how you have in 28 to 44, how you have capital gain section 45 till 55. you have the computation mechanism, cost of indexation less. Similarly, Section 2037 expenses. Under Chapter 12, it is a standalone provisions by themselves, gives how to compute taxation for these special cases. So this 115A provides for tax rates for non-residents for income, royalty, FTS, interest, royalty, and FTS. Now, they've also gone another step. The another step is, look, I can't expect you to come pay taxes, because if you ask a non-resident, you have to pay whatever the concessional rate. They may not pay. Then how will I go recover from them? I cannot go to another country and say, come pay your taxes, give demand. There's a public international law issues also will come into picture. I cannot just like that go and summon a non-resident. I should have a jurisdiction. So what the government has done is, the government has, just like how we do for TDS, and TDS is an easy mechanism, they have introduced machinery provision in the form of tax directorate sources, which we will also look at Section 195 majorly. Therefore, a resident payer will have to withhold taxes and only then make the balance payment. So that's why, as resident taxpayers, it is very important for us to correctly withhold taxes, understand the Section 916, 917, because the onus on collection has been passed on to the government, to the resident payers as agents. So it is our duty to collect the withhold. When I mean withhold, tax deduction is called withholding of taxes. I deduct taxes at source. So this is broadly the mechanism in which non-resident taxation overall works. Now let's look at 115A, because we were looking at interest and interest, royalty, and FTS. So 115A of the Income Tax Act, which I mentioned, gives a special tax rate. I mentioned too, this comes as part of Chapter 12, separate standalone mechanisms governing taxation of non-residents for interest, FTS, and royalty. So 115A gives a concessional tax rate with respect to gross amount. So therefore, it is on the gross payment you make. So on that gross amount, the tax rates will be determined as per 115A. Now, for whom it is applicable? This is applicable only to a non-resident or a foreign company. Non-resident can be an individual as well. So therefore, 115A being a special governing mechanism. Now, what are the incomes? As I indicated, it is for interest, royalty, FTS, and dividend. So these are broadly. Now, what are the taxable concessional rates? For interest, it is taxed at 20%. Royalty, FTS, very, very important, 10% on your gross amount. And dividend, now it is very relevant because dividend comes as part of 20%. So now what 115A says is, if you are a non-resident and you have a royalty or an FTS income and you don't have a permanent establishment in India, then your tax rate in India will be 10% on the gross amount. So you have got 10 lakhs from India. On that 10 lakhs, 10% is your Indian tax amount. This is precisely what 115A addresses. Now, 115A, as I told you, is a special governing mechanism, not part of your Chapter 4 or other aspects. It specifically gives a computing mechanism. This is both a charging as well as a machinery. Just like how charitable trusts are getting taxed under Section 11, 12, 13. Similarly, for non-residents, interest, royalty, and FTS dividends comes under Chapter 12. 115A governs the mechanism. Now, 115A stipulates that if you are going to take the benefit under 115A, it's no option actually. Either you can do it. I mean, you can also do a net basis, but normally no foreign non-resident prefer, because they have to then show the detailed expenses scrutiny. So they're happy with the gross basis, and 10% is a concessional rate. So once you have claimed that, there cannot be any deduction of expenses. You cannot claim any expenses under 37, 36. All those things are not possible. And no Chapter 68 deduction as well. So you can't claim any Chapter 68 deductions available, especially deductions pertaining to incomes under Section 80. Now, another very interesting aspect is return of income. Return of income need not be filed if interest, dividend, royalty income for which tax has been withheld by the resident payer under Section 115A. Now, watch very closely here. Until last year, interest dividend was specifically exempted from return of income filing. Now, effective assessment year 2021-22, it's also good for 22-23 as well. A non-resident having royalty FTS income also need not file the return of income, provided taxes has been withheld by resident payers. Now, what is very interesting is the amendment that has happened says the tax rate should be under 115A, under the Income Tax Act. However, if the taxes have been withheld under the rates specified in the tax treaty, because if you recollect, Section 90 gives a benefit to a taxpayer to choose Income Tax Act or treaty, whichever is beneficial. Let's take an example. In the under 115A, royalty FTS is given at 10%. If under treaty, there is no taxability, or let's assume under treaty, the tax rate is 5%. The specific treaty gives a reduction of 5%. And obviously, if I adopt as a resident taxpayer withholds tax only at 5%, then you need to file your return of income. Return of income exemption is available only if the taxes are withheld as per the Income Tax Act rates. That is, under the rates specified in 115A, that is for interest 20%, royalty FTS 10%, dividend 20%. You are going to deduct, and taxes have been withheld. When I mean you, a resident payer withholds tax for these non-residents under the tax treaty rate, then the government says you need to file your income tax return. So this is a very, very crucial aspect, which from an exam standpoint also, an examiner can test saying a foreign company has not filed its return of income as the royalty or FTS, whatever income it has got, taxes has been withheld under Section 195. Read with Section 90. Section 90 gives a treaty. So basically, treaty rate. The assessing officer denies it and asks to file the return of income. Is the action of the AO valid? Yes. Action of the AO is valid because return of income is exempted under 115A only if the rates are withheld by a resident as per the rates stipulated under 115A, not treaty. So please watch out for this minor but very significant nuance. Now, the other aspects are interest on debt which a non-resident gets in Indian currency is not covered by Section 115A. So only on interest on debt, that is, a non-resident gets an interest income for a debt that it has given to an Indian party, that has to be in foreign currency. Only if it's in foreign currency, you will get 115A benefit. So again, a small minor element, but very significant. So please watch out for 115A. But if you go to the there are other aspects specified under 115A as well. We're going to go deep into it. So as I mentioned in the slides, the dividends is 20%. Royalty FTS is also at 10%. So any royalty fees for technical services for non-residents, the applicable rate of tax is at 10%. However, just one aspect which you can keep in your mind, there are interest. Generally speaking, interest is taxable at 20%. But however, what the government has done is to promote external commercial borrowings as well. So if there's any interest received from an infrastructure debt fund, 5%. And similarly, masala bonds, 194 LC and LD, basically to promote this thing. So in respect of any monies borrowed by an Indian company, there are certain stipulations given. There's a concessional tax rate of 5% and 4%. So these are tax incentive mechanisms to promote monies to be borrowed from bonds, rupee denominated bonds or a masala bonds. So but anyway, these are academically significant, but please have a look at these rates. I'm not going to dwell into all of these aspects. But majorly, what you need to keep in mind is dividend 20%, interest 20%, royalty FTS 10%, and more importantly, if you come under 115A, this is a special rate of tax, and only for these incomes, and then you cannot claim any deduction in respect of any expenditure, and you don't need to file your return of income if the tax withholding by a resident has happened on these rates specified under 115A. But if the resident has opted for a rate that is in the tax treaty, which is a rate lesser than the 115A rates, then the non-resident has to file its tax returns. Now, having said that, we have seen the rates. Now, the next final piece in this entire non-resident income taxation is, you have seen the source. You know they are a non-resident, deemed to occur in India. We saw the categorization of income, salary, dividend, royalty, FTS, capital gains, and specifically for royalty FTS, interest, dividends, you have section 115A, which stipulates the tax rates. Now, what they have also done is, as a last step, to ensure that the non-residents pay their tax. It's very difficult for me to invoke the non-residents to pay. So therefore, circular number 152, 1974 circular, introduced section 195. So section 195, of course, today now we also have other TDS provisions for non-residents, but 195 at that point in time was exclusively for non-residents. We'll see what are the others, but 195 is a very major section that was introduced, rationale being very difficult to collect tax from non-residents. So, and tax also needs to be collected at the earliest point of time. So therefore, when a resident makes payment, he can withhold TDS, which we are all familiar with now. And therefore, even at the time of assessment, at least there will be some amount of taxes that have been collected already. So it'll be easy. So therefore, government introduced section 195 and gave the obligation to the taxpayer, to the resident payer, while making payments on royalty, FTS, or any sum to non-resident. The onus is on the resident taxpayer to withhold taxes. Now look at section 195, which is the very key omnibus provision for non-resident withholding. There are other withholding provisions also. We'll look into it, but very important is Section 195. Section 195 is applicable on any sums. Look at the word 195. That's why I say it's very significant and has a wider. Any sums payable by any person to a non-resident or foreign company, which is chargeable to tax in India, must deduct income tax at rates in force. So your rates in force is defined in Section 2, Clause 37A. Rates in force will include both the income tax act rate as well as the rates under the treaty, whichever is beneficial. So the term used is rates in force. It doesn't say you have to specify which rate, because income tax rate, then you need to go to Section 115A. If it is treaty, go to Section 90. So how effectively it works from a resident standpoint is, when I make a payment to a non-resident, I first classify the income. That is very significant. Any sums payable by any person to, so first, am I making payment to a non-resident foreign company? Yes. And what is that income? Royalty, FTS, it can be anything under Section 9, deemed to accrue in India, or if it accrues, okay. Normally it will come under Section 9. Then is it chargeable to tax in India? Yes, chargeable to tax in India, because Section 9 says it is deemed to accrue in India. Then how much is taxed? There's a special provision, says Section 115A. So you need to go to Section 115A to determine the rates. So for royalty FTS, Section 195 will not tell you the rate. You have to go to 115A to find out the rate. 115A says you have to deduct it at 10%. So when I make a payment to a non-resident for fees for technical services, means a resident makes a payment to a non-resident for fees for technical services, then the duty is on me to withhold taxes at the rate specified under Section 115A. I have to do it. Okay. What if I don't do it? What if you don't do it? The consequences of withholding tax default is onerous. So that's why it is very important provision even for residents. So we cannot ignore it. So when we as an advisor or as an employee, it is very important that we need to be, because the government has given the responsibility to the resident pay. So look, you are availing the services of a non-resident, then it is your duty to ensure that taxes are appropriately collected. How? You withhold the taxes before making payment to them. I have given you the mechanism under 115A to find out the rate. See the rate and then withhold the taxes under 195. Because 195 says any sums payable. So any sum paid to any sum. It doesn't say any income. It doesn't say any profit. It says any sum you pay to a non-resident. So sum means anything. Any sum you make. Basically, they want to bring it as a gross basis. That's why it is. Because when I make a payment on a gross basis, that is more like a turnover tax. Because just like what happens in GST, 100 rupees plus GST, that 100 is actually not my income. I may have certain expenses. My net profit or net income is after those expenses. So that's why that word used in 195 is any sum. On a gross basis, you are taxing it. Net basis means they'll use the word profit, because income taxes are taxed only on profits or your net income. Now coming back, what if I don't withhold the taxes? If I don't withhold the taxes, the resident will be treated as a resident payer, will be treated as an assessee in default under Section 201 of the Income Tax Act. And interest and all those things will come. Not only that, possible penalties will also come for not withholding taxes. So it's my duty to ensure that I'm not an assessee in default, otherwise huge interest payment and penalty. My expenses will also be disallowed under Section 4041, similar to your TDS. I'm not going to go into it. You guys are familiar with it. So my expenses get disallowed. And not only that, I have a lot of penalty issues as well. That is, failure to pay tax deducted 221 will come, 271C for failure to detect tax, failure to pay tax detected, failure to detect tax, failure to file TDS return, failure to furnish information or furnishing inaccurate information under Section 195. Section 271I gives a penalty. Then under 201, there can be a charge, so other consequences as well. And finally, adding salt to injury would be that I may be prosecuted for failure to pay the tax deducted. That's the final nail in the coffin. You don't do it, 276B prosecution, go to jail. So therefore, the onerous responsibility is on the taxpayer, resident payer, to ensure that the taxes are appropriately withheld. So there's a lot of role for the resident. So you cannot, okay, it's just the non-resident has to do it. No. As a resident service recipient, when you are, or as an Indian shareholder, make Indian company making payments dividends, or as an Indian borrower, while making payment to a non-resident lender, you need to be mindful about Section 195 and other TDS related provisions for non-residents, because they can also treat you as a representative assessee under Section 163. Now, amidst all these interest penalty, as I already mentioned to you, there is also something called a 195A gross up. Now, what does it mean is, which I have already explained to you. Normally, what non-residents, because of bargaining power, they will come and tell the resident service recipient, you want my services, pay 100 rupees. I want 100 what's it? Any taxes you have in India, withholding, whatever you are, you bear it. Don't involve me in the picture. So from an Indian payer standpoint, it's not the 100 rupees the fee, it's 100 plus the TDS position. The tax rate has to be grossed up. So his cost will balloon up because he is bearing the tax. And that the tax authorities have also validated. They said, yes, 195A, you can do a grossing up of the taxes. Now, having seen Section 195 in terms of any sum being payable to any person, deduct income tax at force. Let's look at this question here. Question number 21. Messrs. ABC Private Limited. Share the screen. So question number 21. Messrs. ABC Private Limited here, while making a payment to a foreign company for importing goods from the foreign buyer, the foreign company did not have any business connection in India. Hence, ABC Private Limited did not withhold tax, as the said sum is not chargeable to tax under Section 5, read with Section 9 of the Income Tax Act. However, assessing officer contends that the ABC Private Limited should have deducted tax under Section 195, because the assessing officer's contention is this is any sum chargeable to tax under Section 195. So any sum means you have to pay. I mean, you should have withhold taxes. So this is the danger you have. They go behind the resident payer and say, why you have not withhold taxes? Now, Section 195 also, best part is, if you look at Section 195, it says any sum payable to any person to a non-resident which is chargeable to tax in India. This is very important. So it doesn't say any sum payable to a non-resident deduct income tax. If this is not there, then the AO's contention is right. But the section clearly says which is chargeable to tax in India. So therefore, for the non-resident, the sum has to be taxed in India. Under section 5, read with section 9. So here, the resident payer says, look, there is no business connection, and therefore there is no need for me to withhold taxes, and hence I have not done. This is valid. The AO's contention is invalid because section 195 deduction is required only if the sum is chargeable to tax in India. Now, next follow-up question, not a follow-up question, but just taking a thread from it is very interesting. You may have this, there should be a doubt that should have arisen, look, we discussed royalty FTS today. We saw how widely those definitions are. And the onus is also on the resident payer to decide. So therefore, many times the resident payer will be worried if he takes a view that, no, this is not a royalty, this is not a service. Look at a similar conundrum or a catch-22 situation. Incidentally, question number 22, XYZ Private Limited is proposing to make a foreign remittance to ABC UK for one of its service providers. Sorry, one moment. Lost my other screen hence. Okay. Just give me a second. Nisarg, is my slides visible? Or my screen visible? Okay, sorry. I lost this, so let me just put this. But meanwhile, for those, I mean, I've already uploaded the problems in the dash this thing, so you can have a look at it. Now, in this specific question number 22, I'll try to put the screen on. But until then, the question number 22 largely tries to mention that an Indian company which wants to make a remittance to a foreign company, but it is not sure as to whether the said income is chargeable to tax or not. And hence it's caught in a situation as to whether it should withhold the taxes or it should not withhold taxes. So now this is a very common so these kind of situations are pretty common because you don't want to take a chance saying it is not taxable, and tomorrow the problem is the government will come behind you as a resident, say, hey, why you didn't pay your taxes, and then why you didn't withhold taxes, and then you saw what are the consequences of not withholding the taxes. All right, so this is up and running now. So this is a common situation. So therefore, what normally will be done is the section 195 gives you a mechanism. That is, the payer can approach the assessing officer. When you have a doubt, then you can make an application in the section 195 subsection 2. and he feels that whole amount is not chargeable to taxpayer. Now 195.2 is an option available to the payer. She can go and apply to the assessing officer and say, hey, you determine the amount which is chargeable to tax. I'm not sure. I'm confused. I believe this is not taxable. But if I don't tax it, you are going to come behind me and saying why you did not tax it. And then you are going to initiate with TDS proceedings, assessing default. So to ensure that you are not put in uncomfortable situation, because the last thing you want is, you don't want to get penalized for a mistake, because anyways it is a withholding tax implications. So you can go to 195.2. 195.2 forms are prescribed, and this is where we represent and say to the payer, that is to the resident, whether it's taxable or not taxable. Now, continuing with this situation, move to question number 23. ABC Germany, which is a German company, is engaged in a business transaction with an Indian client. The Indian company declares that it is going to withhold the tax under section 195 before making the remittance to ABC Germany. ABC Germany says the income is not chargeable to tax. So hence it reaches out to you, being the Indian tax advisor, says, hey, look, they're going to withhold tax from me. This is unfair. I don't want to tomorrow file a tax return to claim refund, or my country, or German country, may not give tax credit for this. I don't think this should be taxable. Now, why this is also very important is because generally speaking, any resident taxpayer would like, why should we take the trouble? Let's withhold taxes. I have to pay you 100. I will pay 10 to the government, give 90 to you. It is then up to you and the Indian government. Do whatever you want. So this situation is also to the extreme, where you keep withholding taxes when it may not even be taxable in India. So therefore, the tax legislation gives you a benefit here. This is for the payee. The payee can also make an application to the assessing officer. So when I mean the payee is the recipient here. He can make an application to the assessing officer under section 195.3 and say, hey, look, I believe this should not be liable for taxation. These are my facts. These are my points. Please notify. So the assessing officer will then come out with an order, say, should taxes need be deducted? If it is not deducted, I will go give that order to the payer and say, hey, look, I have a 195.3 order, which says that there's no need for any deduction of taxes. Similarly, there is also 197, which is again for a payee. So the payee has two mechanisms. Anyway, these are not going deep into it. So there are basically mechanisms for the government, for both the payer, that is the deductor, as well as the payee, the recipient, to approach the government, approach the tax authority, and try to get a clarity on what is the amount to be taxed. Because, see, domestic law taxation is one aspect. There are treaty also, we have to look into it subsequently. Treaty may have some different interpretation and taxing rights. So things may get little complicated and interesting. So that is why, taxpayers will prefer to go for a 197 order or a 195 order. Finally, on the withholding tax, why all these I'm telling to you is, even from an academic standpoint, is very important, as well as for practical is, there are certain procedural requirements stipulated. That is, before filing these, before making a payment, a resident has to get a chartered accountant certificate if the said sum is taxable. This was actually legislated recently under 195.6. Previously, the requirement of a chartered certificate was only under the FEMA. The FEMA stipulated any foreign remittance made to a non-resident, there has to be a no objection certificate from a chartered accountant, because money is going outside India, saying that this money has suffered taxes in India. They wanted the FEMA stipulated. That over a period of time got legalized in the Income Tax Act as well. And there are forms and rules where it stipulates when is a chartered accountant certificate required, when is a personal declaration from the taxpayer required. That is covered under section 195 clause 6. So basically 195 is a major withholding tax provisions that one should be aware about, because it covers any sums, any other sums. Now, apart from 195, there are certain specific TDS provisions available under Chapter 17B. Those are, what are these? Salary, as you know, any salary payment to a non-resident, 192 TDS mechanism, similar to a resident, will come in. There are other aspects like, we've already seen this, investment funds, when any income received. These are again very specific to give incentives. They are not included under 195. They were separately came under 190, because any time the government may remove these TDS provisions, because any non-resident getting income from an investment fund in India, under 194 LBB, you get a concessional rate. 194 LBC, 196 in respect of mutual fund. You may wonder why didn't they include it in 195? The reason for they not including in 195 is they want to give separate tax concessional rates, and any point in time, once they feel the need that, they realize that this is no more required, this incentive need not be given anymore, it's easy for them to delete this section and bring it under 195. They'll really remove. So that is the reason why there are certain sections, TDS sections under Chapter 17B, which is very important for non-residents other than 195. So one should be vigilant. If you look at even the material covers, you can have a look at it during the weekend. I would recommend you to just go through this so that withholding tax provisions 192. Again, for 196A, income specifically from any units or mutual fund for non-residents. And then you have many payment on offshore fund. So as I mentioned, these are very specific tax incentive driven. Government wants to promote Indian capital market and other aspects. So therefore, they come in a separate section. And after some point in time, they will remove it. 196C, if you see income from foreign currency bonds issued by an Indian company, in order to encourage foreign institutional investors to come and invest. So you have to give them a less rate to attract them. So it comes at only 10%. So these are, those kind of situations. Similarly, exclusively for foreign institutional investors. Today, the Indian capital market is driven by foreign institutional investors. So under section 196D, any payment that you make to a foreign institutional investor, tax needs to be deducted. If you go to 196D, specifically, they would have said 20% or treaty, whichever is beneficial. So tomorrow, the government may say, no, FIIs, why should we give them a separate beneficial rate? They may even remove it. So that's the reason why these are not part of section 195. Again, 194 LB, LC, or very individual investment specific, you can just have a look at it. 195, this is what we had covered in detail, because invariably, many of the non-resident income will come under 195. Any other sum payable to a non-resident. All right. So with this, what we have done is we have covered section 9. We have covered the withholding tax, especially on 195. There are some withholding tax, for example, payment to sportsperson, as you can see, 194E. I will cover that along with chapter 12, because in chapter 12, if you recollect, 115A is one of the taxing mechanisms. 115A exclusively for interest, dividend. There are also other incomes, for example, non-resident sports persons income, foreign institutional investors income. So there are other specific incomes that come under Chapter 12, determinants of tax in certain special cases. So we will look that and 12A and other aspects, the remaining aspects in the next class. But today, as I mentioned to you, we largely looked into Section 9, which is very, very important, major taxing source for the Indian government for non-residents. And Section 9, once the income becomes accrue or rise in India, how do you tax them? The taxing mechanism is available under Section 115A, which governs the taxing mechanism, special tax rates applicable to interest, FTS, royalty. And then, after arriving at the tax rate, who will pay it? The tax collection can be directly the non-resident can pay through a self-assessment mechanism, or can be through a withholding tax. The government preferred to go for a withholding tax mechanism. So that way it's easy for them to collect and collect in advance. So they have passed the onus on the resident payers under Section 195 and few other sections. Largely 195 is very relevant. So with this, we have covered the major structural aspect. In the next session, we will look at some presumptive tax. Why do we need presumptive tax? And some other incomes that are relevant from a non-resident standpoint, including what are the incomes that is exempt under Income Tax Act in Section 10 for non-residents. So with this, complete today's session. Let me see if there's any question. Meanwhile, I will request you to please go through the problems against which we solved, and also the material in terms of what we have covered so far over the weekend. And then I'll happy to take them up as questions in subsequent sessions. Okay. Got some questions. How a non-resident can file return of income as it does not have a PAN? Oh, very good. Namita, one other important tedious point which I mentioned, which I didn't mention, is 206 AA. So basically, the non-resident must also have a PAN number. So if the non-resident is taxable in India, and if he does not have a PAN number, Section 206 AA will, I'm sure you would have heard about 206 AA in your TDS. So 206 AA is a non-obstante, overarching provision. So that way the government is trying to encourage taxpayers to obtain PAN. Now, so 206 AA, if there's income taxable, then you need to, the non-residents will also have to obtain PAN. If it is not chargeable to tax, not a problem. But in order to have a return of income, you need to have a PAN. So therefore, one needs to apply for PAN as well if return of income has to be filed. And that will come under your international tax jurisdiction. You can give your foreign address and file here and get a PAN. Getting a PAN is no more an ardent task in this day and age. If non-resident pays to non-resident, can supplier avail 150? No, if non-resident pays to non-resident, and if it is a fees for technical services, then yes, because you go to Section 115A, who now has to withhold tax? If you go to 195A, 195A says any person, it doesn't say resident have to withhold tax. Any person will have to withhold tax. So even a non-resident will have to withhold tax while making payment to a non-resident. Any sums payable, that's why I've highlighted as well. Any sums payable by any person to non-resident. So a non-resident making payment to a non-resident, and it comes as part of Section 916 or 917, then the person who is making, non-resident who is making payment to another non-resident has to get a TAN, has to do withholding tax under Section 195. So what is the rate? To go to 115A, the rate is, if it is royalty FTS 10%, if it is interest dividend, it is 20%. So that is why we have to be very careful when there is a payment between non-resident and non-resident, and it pertains to any business or profession utilized or for earning a source of income in India. They have to do additional complaints, getting a TAN number and filing the taxes. I hope this answers your question. Now, if John pays for services used for business in India to Sam, how tax amount will come to? Excellent. Yeah, see that's so now what this is very good that you asked. Again, how will the government know that this payment was made? It is very difficult, but the government, while doing assessment for the Indian company, let's assume they somehow get to know this. Today, exchange of information. Yes, I'm not sure how they'll get to know, but if they get to know, then they can use the treaty route, because under the respective treaties, Article 28 gives a mechanism for recovery of taxes. So you can approach the tax. So let's say John Italy making payment to Sam Japan for India. Italy, John should have withhold taxes under section 195. John Italy has not withhold taxes. Now there are two ways it can happen. India can go to John Italy and say, hey, you did not withhold taxes, so therefore come pay tax. Now John Italy will throw the notice into the dustbin. But what now India can do is approach the Italian tax office and say, hey, look, this is squarely coming under section 917 of the Income Tax Act. This is a deemed to occur in India, and John has the responsibility to withhold tax. He has not withheld, so I want him to withhold. Or alternatively, can go to Sam and say, pay tax of 10% under 115A. That is more easy. So they'll go to Sam Japan and say, because the payment would have already happened. So they'll go to Sam Japan and say, hey, look, you've got 100 rupees from John, and that 100 pertains to income in India, FTS. Under the Income Tax Act, 115A says 10% is the taxable. Sam, Japan, please pay the tax. Sam says, no, I will not. Okay, no problem. Go to Japanese tax authority and say, please help me in recover the tax. And India, Japan has agreed the treaty that they'll help in recovering the taxes. So this is how it will happen. You have to use diplomatic routes and treaty to do it. What is rates in force? Is it as per 115A or is it as per Finance Act? Rates in force is defined under section 237A, which includes all the rates specified under the Finance Act, rates specified under the respective Income Tax Act, also rates under the treaty. So 115A is also a rate in force. So any rates that is specified under the Finance Act, they would have also mentioned 115A. So go look at 237A. 2 clause 37A for rates in force definition. You will understand. It would have captured 115A. It would also captured 195 would have been captured. So 195 now goes back to 115A. Slightly circuitous. I'll not go deep and confuse you. But rates in force will also include 115A. Basically, 195 will also be included. When grossing up TDS, whether TDS amount can be claimed as expenses by resident. So grossing up. Now, how it happens? 100 rupees I should have paid the provider. And now, out of 100, 10 I should have withhold. So 90 to the non-resident and 10 should go to the government. But now, what will happen? Because of grossing up, my 100 will become 110. 100, let's say 110. 100 goes to the non-resident and 10 will be my tax expenses. The question is, can this tax expenses be claimed as a expense? Unfortunately, it will get disallowed under section 40. So there is an issue here. So it will be an additional cost without getting any deduction. And the sad part is nobody will get credit for this. So that's why the reason for this is government does not want Indian service recipients to enter into grossing up or net of taxes contracts. They don't want you to do that for the fact that they say, why are you succumbing to negotiation, bargaining power? You will tell, I will do only after taxes. Don't come to 100. Tell, I'll give you 90. 10, I will give it to the government of India. You take it as a foreign tax credit in your home country, or come file tax returns and take refund in India. This is exactly the reason why this. So grossing up will additionally only burden me more than anything else. Now, Naveen Prakash, look at 237A rates in force again. I'll tell you one fundamental. Now, since you asked this interesting question, you can always ask, why are rates specified in Finance Act and why are rates specified in Income Tax Act? This is confusing. One hand, 115A, you are saying 10%, 20%. On Finance Act, the rates are also given. The idea being, if the rates are given under the Income Tax Act, the government has the authority. Government can easily do it, especially for non-residents, keep amending the rates quite easily with a simple legislative power. But when it comes to Finance Act, it cannot do it. It has to pass through the Parliament. So that is why, for certain convenience sake, for example, this 115A, all these Chapter 12 and other aspects, the rates are specified under the Income Tax Act. So it's a logical question one will always have. Why are they confusing? Why are the rates at too many places? One in Finance Act, one at Income Tax. The idea being for convenience. If it is on the Income Tax Act, the government need not wait for the Parliament. The CBDT, they can itself do some amendments. They can pass a TOLA and do it. But when it comes to Finance Act, it has to go through both the houses, and there are certain procedures. So that's the reason why there are two different rates. So when it comes to 237 for the specific rates in force since you have asked, we go to, let me read out for you 202 clause 37A. The reason for me not reading out is very widely worded. So 237A talks about all the income tax under 132, salaries. It also covers, for the purpose of deduction of tax, 193, 194, 195 is also included, and treaty is also included. So therefore, treaty rate is also included. So rates in force will be the rate specified under TDS or rates specified under Section 90. Everything comes under rates in force. So exactly to our fact pattern, to the situations which we dealt, when it says tax has to be deducted at rates in force, the reason for giving rates in force is I can go and see whether Section 90 is also covered. Yes, Section 90 is also covered. And Section 115A is also covered. 195 covers, so automatically 115A also gets covered. Slightly circuitous, but you spend some time, you will be able to understand the concept. Correct. No. What Namita, what I mentioned is, if the NR supplier files return of income, the taxability is 10%. But if it feels that no, this amount is not taxable in India, then it can always file its income tax return and claim a refund, and automatically assessment procedure will open, and you can contend as to why it is not. That is what I meant as refund. Otherwise, it is 10%. If you're happy with 10% giving it to India, okay. But if you still feel that income is not deemed to occur in India, you still feel that treaty benefit is available. Under treaty, it will say business income, no PE. In those situations, you can file a tax return in India and try to claim refund as the tax credit. That is what I was trying to mention. All right, I think quite a lot of things for today. So have a good weekend. Please go through these concepts again. It will definitely be helpful to remember them, and at the time of exams as well. So we'll see you again on Monday. Until then, thank you very much. Take care and good night.